It was a quiet day on Wall Street with the S&P 500 closing higher by about 0.2%. Nasdaq actually closed a little bit lower as a result of a little weakness in some of the mega cap tech stocks. But really the story of the day was retailers. We had both Walmart and Home Depot come out and impressing investors with their most recent earnings report, and their stocks were up by 4 or 5%. That really led the way with a lot of other brick and mortar retailers as well. Keep in mind tomorrow we have more retailers reporting, including Target and Lowe's, so we'll see if it can continue or not. But for right now, we did see a lot of bullishness in that particular area. We did find that about 2/3 of the stocks did close higher within the S&P 500 today. And once we talk about the various sectors in tonight's video, you'll find that all the sectors now have strongly bullish postures that are out there. Then we'll get into our trade application example, where I wanted to focus on a consumer staples company that has been somewhat left behind in this market rally in the last month or two and has been showing signs of life here in the last couple of sessions. So I wanted to show you how to do what's known as a long call vertical spread with tonight's application example. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's August 16th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, go down below into our description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. You'll also find at the bottom of those emails the stocks that are giving you overbought and oversold cluster signals within the S&P 500. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZ. If you're not doing so already, I would encourage you to follow me. And also, we appreciate those of you that click like and retweet on these Market Outlook related posts. Last but not least, we have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's jump into today's trade activity. Get started here with our S&P 500 heat map. And as you can see, it was a little bit more of a mixed bag here today. Kind of a strange day where we were kind of waffling in and out of positive to negative territory within the S&P 500. So I suppose it makes sense that the end result of the heat map looks like this. Now, while you do see a number of our giant leaders in kind of red boxes, today that wasn't as big of a concern as it typically is, because the amount that they were down was quite small. And so just as an example of that, you can see here Microsoft was down 0.26%. Apple was down 0.09%, so basically break even. Alphabet was down 0.3%. Meta was down 0.79%. Tesla was down 0.89%. Especially for Tesla. That stock is nearly always going to be up or down more than 1%. So that just goes to show you what kind of a day was today. Quite a quiet day. At least the end result would suggest that for most stocks that were out there. So were the big boys down today? Yes. But were any of them down more than 1%? No. And so it didn't really have that big of an impact here today. Meanwhile, we did have some relatively large stocks with superior performance today, and you see two major green rectangles kind of lighting up the screen right in front of you, and they stand out because they both had earnings this morning. Some of you know that this is the major retail earnings week of the earnings cycle, and so today we had Walmart and Home Depot come out and impress the marketplace, finishing higher by 5% in Walmart's case, 4% in Home Depot's case, both of those being large companies, not only in the S&P 500, but in the Dow Jones Industrial Average as well, and holding considerable sway over the consumer discretionary, consumer staples types of areas that are out there. Now, keep in mind that 3 months ago, you'll recall that Walmart had one of the worst reactions to earnings in its history, at least for the last several decades, and it was a little bit of a relief, I think, for a lot of investors here today when they seemed to pass with flying colors this time around. Now, keep in mind, because the earnings are staggered throughout the week, there could be some impact as soon as tomorrow when you're going to see Lowe's, the competitor to Home Depot, release their earnings. Now, they were up about 3% today in sympathy with Home Depot, but they could easily give that back depending upon how their earnings are received by the market tomorrow. Then again, maybe they accelerate it even further to the upside. And the same thing goes for Target, of course, being a chief competitor to Walmart. Target was up nearly 4% today. So you can see a lot of healthy green right here in kind of that retailing spot there for the consumer. You'll also find that a number of the banks did quite well here today. There's JP Morgan up about 1%. We talked about that one yesterday afternoon in my options class. We've got Bank of America that was up over 1%. Wells Fargo up almost 1%. Berkshire Hathaway was up a little over 1%. Remember, yesterday was the 15th day of August, and therefore the final opportunity to release the 13Fs for all the major institutions out there. The 13F filing from the SEC requires certain money managers with a certain level of assets to report their buys and sells from the prior quarter, and they give them kind of a grace period of 45 days after the quarter ends to make the official filing. And so a lot of them, like Berkshire, do wait until that final 45th day, and that was yesterday. There wasn't a whole lot to report there. Some of you saw my retweet in that regard when it came out yesterday afternoon, but I didn't really add a whole lot of additional commentary to it because, quite frankly, there wasn't a whole lot to report. Much of the buys and the sells were already in motion from the prior quarter, so there wasn't any big surprise, any brand new investments or anything like that. It seemed like it was more of a status quo type of a quarter there for Warren Buffett and company. You'll also notice that a lot of consumer staples did well. Now, that could have been on the back of the Walmart report, but you've got Procter & Gamble, Coca-Cola, Pepsi, all doing quite well. Some of you saw me tweeting about Pepsi yesterday. That stock's literally hitting all-time highs right now. So while there's still a number of stocks that are struggling in the year 2022 and well off of their highs of the year, there are a handful of elite companies out there that literally have never been higher in their corporate history, and Pepsi happens to be one of them. Coca-Cola is not all that far behind. The beverages have been an area of strength this year, and we have quite a stable full of them in my top-down trend trading class. So we're hoping that trend can continue for a bit longer. You'll see Mondelez was up over 1% today. Philip Morris was up nearly 1%. Its sister company there, Altria, was up just over 1%. So I'd say a pretty healthy day there out of the consumer staples area. Whereas a lot of the other sectors were a bit more of a mixed bag. I'd say in general, technology seemed to be leaning more bearish here today. We kind of had a split decision in healthcare. It seemed like industrials was maybe leaning a little bit more bullishly here today. Energy seemed to be a little bit more bearish today. Real estate a little bit more bearish today. Materials about a coin flip there, and probably a little bit more bullish in the utility world there. So there weren't a whole lot of consistent themes today, other than it did seem like the retailers in general had a dominant performance today, courtesy of Walmart and Home Depot. Let's go ahead and now pop on over to the other part of the platform, get a sense of market breadth here today. And as you can see, I've got the S&P 500 pulled up on the index watch of the visualization area, and 322 out of the 500 stocks of the S&P 500 did close in the green here today. So that was good for about a 64% hit rate. Not too shabby, all things considered. Remember, the S&P 500 was only up 0.2% today, so it was a relatively modest increase for the index. But this would suggest that if you look underneath the hood, there was a little bit more strength than you might have recognized with just the end result. And again, a big reason behind that is your mega caps were largely in the red here today, although modestly so. However, they carry more sway in the end result of the index. But if you were to look at it on a stock-by-stock basis, you actually had a bit more bullishness under the surface than maybe the market was recognizing here today. Let's go ahead and now pop on over here to our 4-grid and go through our discussion about market posture using the market forecast technical indicator. So this is chart 4B for those of you that are premium market scholars following along at home. And I don't really have a lot to report today because we continue to just be cruising, right? We're climbing that wall of worry. We had another up day for the S&P 500, and this is, of course, a new 3-month intraday high and, for that matter, a 3-month closing high. Now, obviously, we're still a long ways away from all-time highs, but if we're ever going to get back there, which of course we will at some point, whether it happens during this run or at some point in the future, right? Stock markets generally do eventually hit all-time highs again. They got to start somewhere. And so we're always looking at those possibilities on the chart where those rebounds could be occurring, and you could make a strong case that the rebound is afoot. One of the things that I think is important with this particular chart right now is how it has acted since breaking out above that resistance area. Remember, we talked about that a week or two ago, how we kind of were stalling out right there during that week at almost the exact same level that we were stalling out during this week back here. But notice the last 5 candles. Once we had that gap up from this candle to this candle, notice that air pocket in between there, we've largely gone higher. We've gone up basically 4 out of the last 5 days, the only exception being that candle right there. And so that is giving us a sense that it's been relatively easy for the bulls to prove their case here and to lay claim to the fact that they are now in control of this market. Now things do change, of course. That's the nature of this business. Cycles, cycles, cycles. Bulls give way to bears, bears give way to bulls. It's a matter of how long it takes. But right now, I would say that the bulls are clearly in the driver's seat, and the posture of the market forecast has been there to kind of assist that mindset, with that green line continuing to be in the upper reversal zone. So remember, whether that green intermediate line is rising or falling doesn't really matter as long as it's trading above 80. That's where the upper reversal zone begins there for the market forecast technical indicator. So with the intermediate line here at 97 and rising, clearly we remain in strongly bullish territory. And that has been the case for the better part of the last month plus. Remember, we went to a weekly bullish posture back here on July 19th. And then just 2 days later, we went to a strongly bullish posture. And we've remained in a strongly bullish posture with that dark green background color ever since then. So there's been a lot of doubters. Even myself, I will say that it's been a little surprising to me to see the bulls have this type of resiliency after getting trampled on for 6 months to start the year. But the market doesn't really care about what any of our individual thoughts are, which is why traders generally are better off trading what they see as opposed to what they think. And right now what we see is a bull market, or at least a trend in a bullish direction at this moment in time, and really hasn't given us the sensation that it wants to give way to the bears quite yet. Eventually it will, but right now we see a pretty substantial rise from those lows that we experienced here just a couple of months ago. On the Dow Jones Industrial Average, we were up 0.71% today, so the Dow actually led the way today. And again, when we looked at that breakdown of the S&P 500 heat map, that should make sense. Remember, two of your most important stocks here today were Walmart and Home Depot. Both of them happen to be 2 out of the 30 stocks on the Dow Jones Industrial Average. So today was a rare day where we had an up day, and the Dow was the one that led the way because of the specific composition of the Dow itself. But that was a pretty aggressive candle there, and this is actually the 5th day in a row for the Dow. So I mentioned the S&P 500 had at least one down day along the way. The Dow didn't have a very good looking candle that day, admittedly, but you did still close slightly higher than the previous close. And so this technically is the 5th day in a row to the upside after that gap up for the Dow Jones Industrial Average. No surprise there. We remain in strongly bullish territory from a posture perspective there as well. Now down on the bottom rung today, the Nasdaq actually underperformed. It was down 0.19%. Again, that probably makes sense given that when we just looked at all those technology companies like Apple and Microsoft and Google and Facebook/Meta, those were largely lower today. So tech stocks do have a larger influence on the Nasdaq composite. And so on a day where today tech stocks kind of gave way to more of the retailers and the consumer staples and things like that, it's not a huge surprise to see the Nasdaq struggle in comparison. But even still, you'll notice that there is a high tag above the candle here today, telling us that on an intraday basis, the Nasdaq, just like the S&P 500 and just like the Dow Jones Industrial Average, and for that matter, just like the Russell 2000, all of them hit 3-month highs here at some point today. It's just that the S&P 500 and Dow Jones closed in the green, whereas the Nasdaq and the Russell 2000 closed slightly in the red. But as you can see, we retain that strongly bullish posture here on the Nasdaq as well, according to the market forecast posture setting system. And then the Russell 2000, I guess you could say it was a loss here today because technically it was down 0.04%, but let's be honest, that's about as close to break even as you can get. It kind of looks like a bit of a doji type of a candlestick here today. Sometimes that can be looked back upon and said that that was more of an indecisive type of day, but you usually do need more confirmation the following sessions to make that determination. Otherwise, it could just be stalling out in the midst of a continuation pattern. So we'll keep our eye on that possibility, but for right now, we have to assume the trend is higher, right? The path of least resistance clearly higher on all four of these charts. All four of them remain well above a rising 30-day moving average, regardless of all the negativity you might hear on CNBC or elsewhere. The charts are suggesting that there's more bullishness in the air than what a lot of people are willing to give credit for. So it's been kind of interesting. The Russell 2000 has been on quite the ascent here recently. We've been kind of focusing on small caps and small size factors in my swing trading class. And there were a handful of stocks that have just been bursting out of nowhere in that category. One of them I tweeted a little bit about earlier today because it just happened to be a stock we looked at last week in my Wednesday swing trading class, and that's Blue Apron. And you can see that stock, we just looked at it right here on Wednesday, and our price target was going to be this green horizontal line here, and you can see that this stock has just blasted through that. Now, it only closed up 16%. I use that term only loosely in this case because, of course, 16% is amazing type of a performance for one day for any stock. But earlier in the session, it was actually up 31%. Now, that one wasn't alone. Many of you probably saw the meme craze taking place with Bed Bath & Beyond today. Now, perhaps the Walmart and Home Depot news were the catalyst there with another brick and mortar retailer here, but Bed Bath & Beyond went absolutely crazy today to the upside there as well, up 29%. This one was up like 60% earlier in the day, but then gave back a lot of it. You can see this long upper shadow here, but anybody who owned it as of yesterday and then held it as of today's close are probably still smiling with that 29% increase there. And then I did see another small cap company, Eargo, go kind of bananas here today as well. This one was up 77% here today, and this one actually closed a little bit closer to its highs of the session, unlike Blue Apron and unlike Bed Bath & Beyond. This particular one was affected by some news that hearing aids were going to be legal to sell without a prescription. And this company sells hearing aids, so I suppose it makes sense, given the news, that there was a sharp rally here. Whether it deserves 77% or not, we'll all find out as time goes along. But at least for one day, you see some really epic rallies there out of many of those small cap companies. And so there is plenty of kind of more speculative fervor in the markets right now. And remember, that's another sign of bullishness taking hold. Usually you don't have market participants willing to chase stocks up 20, 30, 40, 50, 60, 70% in a single day. But we've seen a number of those incidents here recently, and it's telling us that animal spirits are once again alive and well. That could end up crashing at some point. So we have to be mindful of that, and we don't want to just blindly chase stocks, but it is at least a way to kind of take the temperature of the market. And right now the temperature does definitely lean more bullishly, just like all of these posture setting mechanisms that we use in this presentation suggest. All right, let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support this free video that you'll find here daily on YouTube. And there's a number of ways that you can support us in our efforts, but the main way that we ask that you support us is simply by clicking like there for us on Twitter. That goes a long way in our book because it's a way that David and I can reach out to a much wider audience than we would be able to on our own. When you're liking our content, it is showing up on your social network effectively. Other friends of yours will see that you may have liked our video or what have you, and that might spur their attention to start checking out the videos for themselves, and so on and so forth. So that's the idea. Whether it actually works out that way, in practice or not is anybody's guess. But we simply ask you to help support this presentation because it does take 3 hours out of our day to do. And so we have to honestly ask ourselves a serious question, which is, do we have the time and the motivation to do the videos, knowing that we don't make any money doing the videos, but hopefully helping assist you, educate you a bit along the way, and then hopefully getting the word out about our business along the way as well. And of course, remember that it also benefits you when you're liking our content on Twitter, because you're starting to train the Twitter algorithms that you want to see more of our content, and that way you won't miss as many of our tweets and other things that we post throughout the day, trying to train you up along the way. So thank you very much to all of you that do support us, and especially to the 116 of you that clicked like for me there the last time around when I did the video on Thursday. Remember, anytime I'm up and over 100 likes, I'll be happy to do a full-length video, including a trade application example for you the next time I'm scheduled to do the video. If we're under 100 likes, then I just plan on doing a quick little 15-minute quick hitter type of a video on only the indices with no trade application. So I'll let you guys decide collectively if you prefer the longer form videos or if you just kind of want us to get along with things and make it quick. So if you like these longer videos, simply take 5 seconds out of your day to click like for us there on Twitter. It doesn't cost you a cent. Also, while we're over here, a reminder that David and I both taught classes today. I taught my dividend growth investing class, which of course is my passion as an investor. And today we focused on the consumer discretionary space. So if you're interested in that content and you're either a plus or a premium member of Market Scholars, you can come up here to our trading rooms calendar and watch the recording. And then David taught his directional option strategies class earlier today as well. So make sure you're checking that out if that is of interest for you. Tomorrow morning, I'll be back in action with factor-based swing trading at 11 a.m. Eastern time. So let's see if we can find another Blue Apron type of a setup tomorrow. And then David will be at it a little bit later in the day, 2 p.m. Eastern time, with his options inventory trading class. Also, while we're over here on the internet, let's take a quick peek here at the sector selector. A reminder that this gets updated on Friday nights, and so this information is a couple of days stale right now, but can still give us a general sense as to what rotations may or may not be taking place within the market. And so the main takeaway here this week is that information technology still commands the #1 slot. This is now the 4th week in a row that tech stocks have been leading the way in this market. So it's not just an overnight sensation. It's not a one and done. It's not a fly by night. There is some staying power here with technology, and I think that's important for the market's prospects in general as well. Remember, technology tells us something about risk appetite, but it also is highly influential on something like the S&P 500. Technology is the largest sector out there from a market cap perspective, so if it can remain strong, it's going to give the S&P 500 itself a much better chance for it to stay strong along the way as well. Whereas when technology is near the bottom, you have the opposite situation. It's hard for the market to make any ground and have any traction if the tech stocks are not performing well. But right now we've got Apple pretty close to all-time highs, only 4 or 5% away or whatever it is, all of a sudden, after just talking about how tough it was earlier in the year, many of them have been firing back very nicely. Industrials also have had a really strong move here in the last 5 weeks. You can see industrials were ranked number 6 back here in the middle of July, and every single week they've gained ground 1 slot and have now made their way all the way up to number 2. And so a lot of companies out there, Boeing comes to mind. Even 3M's had a little bit of a rally here lately. Some of the defense contractors are holding up reasonably well. General Dynamics, Raytheon, those types of companies. So, keep your eye on the industrials. That's been an area of focus of ours in my top-down trend trading class over the last month or so. And there's plenty of charts there that are hitting multi-month highs. So if you're looking for relative strength, the industrials do seem to have quite a bit of that. All right, let's go ahead and pop back on over to the main part of the platform. And let's take a peek here at some 12 grid analysis, starting with chart 5A. This is our asset class 12 grid. And so this will be everything from stocks to bonds to commodities to currencies to interest rates and everything in between. So as you can see here, there's different colors on the charts. The green colors will identify bullish postures. The pink charts will identify bearish postures. And there's two different shades of each of those colors, either light or darker, to signify either weak postures or strong postures. And so when we look at this, we actually see that there's only one light green chart right here in the bottom right-hand corner. And actually there's only one light pink chart as well, which is in the middle rung, second from the left. So those two would be considered weaker postures. So in other words, the 10-year Treasury yield is considered a bullish posture right now, but it's not a strongly bullish posture. It's more of a weak bullish posture. And then the opposite is true there with the foreign bonds. They have a bearish posture right now, but it's not strongly bearish. It's only weakly bearish. So in other words, foreign bonds could easily flip back to strongly bullish, much more easily than you would see with something like, let's say, TLT, which has a strongly bearish posture. And then the opposite is true here with TNX. You would find that it would have an easier ability going to strongly bearish than what you might find with, something like high yield bonds up here, which has a strongly bullish chart. So it usually works in phases. And it's kind of like, think of it as almost like a warning signal. Like, yes, we recognize there has been some strength or weakness in the charts, but it hasn't been persistent, and therefore it hasn't been really confirmed long enough for you to get overly excited about it quite yet, right? So that's kind of the mindset there. So today we did see rates rise. TNX did close at 2.82%, and it's kind of flirting with the 30-day moving average right now. For a while we were breaking out to the upside, interest rates kept going sky high, and then we had the exact opposite, and they were breaking down, and it seemed like they were just going to fall off of a map, and now we're right back in the middle of the two extremes, sitting right at the moving average itself. So it can't really make up its mind right now. But the good news is, for the market's perspective, that when we kept on pressing up and through the 3% level on the 10-year Treasury yield earlier this year, that seemed to be at a time when the stock market just was not having it. They did not like that at all. They were selling the stock market off pretty aggressively as interest rates became more and more concerning. Remember, much of corporate United States, the corporations in the United States have lots and lots of debt. That we talked about that quite a bit in my dividend growth investing class earlier today. It's rare to find stocks that have no or little debt. Many of them fell into the temptation of taking on additional debt in the last 10 years, even if they didn't need it, right? Even Apple and Berkshire Hathaway did corporate debt offerings, even though they're some of the strongest companies on the planet. They did it because they could, and interest rates were cheap, so their CFOs suggested it would be a wise idea just to have as almost a rainy day fund if they needed it, eventually down the road when money was more expensive. So point being, when interest rates kept on going higher, it seemed like day after day, week after week earlier this year, it really startled the stock market, because the market knows that much of the corporate United States is heavily indebted at this moment in time, and many of them have become addicted to that debt, and therefore if they're addicted to the debt, they might not be able to stand on their own ground without the debt, and if that's the case, then they might need to continually refinance their debt load. But the problem with rising interest rates is you're not refinancing at terms that benefit you as the corporation who was the previous borrower. You're going to be at the disadvantage there, because you're going to have to roll over into more expensive debt. And so the good news is that conversation has kind of taken a back seat here more recently, as we've seen a little bit more of a breakdown in the yield environment, and that has been supportive of more bullish activity within the stock market. At least that's one of the reasons out there. Anyway, on the left-hand side here, you will see that the U.S. dollar remains with a strongly bearish posture, but I'm not sure how long that's going to last. You've actually had a pretty good recovery there in the U.S. dollar prior to today. We were down just a hair today. We were down 0.04%. But you'll notice that prior to that, we had 3 days in a row to the upside, and 2 out of those 3 days were pretty aggressive days. So if we get another up day tomorrow on UUP, I wouldn't be surprised at all if we go back to a bullish posture on the U.S. dollar. then again, we are sitting right at that moving average, which could easily act as resistance. So maybe there's a sell-off in store tomorrow, and that would be an opportunity to put on more bearish trades on the US dollar. So we'll see, but this is a pretty critical level where we stand right here, right now. Gold has had a reasonable recovery over the last month, right alongside the stock market, but it's kind of been the opposite of the US dollar. And remember, that's often the case when the US dollar is strong. Commodities, all else being equal, tend to be weak, and then when the U.S. dollar is strong, or I should say, when the U.S. dollar is weak, then you see commodities do better. And now look at the last week where we've had strength in the dollar and we've had a give back there in gold once again. So we're seeing that kind of play out as expected at this moment in time. The one thing that I would say in gold's favor here today is notice that something new is happening on the chart. And that is that we now have a green moving average. For those of you newer to the video, that's a 30-day moving average. And this is a color system that we use here on these customized charts that we make available for all of our premium members that will basically tell you different things about where we currently stand versus the moving average in question. So when you see a green moving average like this, what it's telling us today is price is now above a rising moving average. I know it doesn't really look like that probably with a naked eye, but trust me, it goes in and actually measures what was the reading today versus yesterday before it starts coloring that moving average itself. So at a minimum, you can see a flattening out of that moving average down below. And that's a good sign for gold because in this particular case, we didn't struggle much when we got to that falling moving average. That was originally my fear. I was not surprised to see gold bounce because we had all these oversold cluster signals. But my fear was once we bounced, we would start rolling over right around that falling moving average, and that wasn't in the cards. This one actually stabilized and actually added to its strength in the week after that. Now we're seeing a little bit of a rollover, but because we went up for an additional week after I assumed there would be some selling pressure, this is setting up the possibility that it could actually stabilize and find some support above that rising moving average moving forward. Now, a lot of that is out of gold's control. It is dependent upon what happens with the US dollar and a lot of other things out there. But just from a purely technical perspective, I'm starting to get a little bit more comfortable with the idea of long gold here for trading purposes. I got a question about gold as a long-term investment in a Q&A class recently, and I'm not really the type of guy who's a big fan of holding gold for the long term. It just hasn't proven to be all that useful in the vast majority of market environments. But certainly gold is a great trading vehicle. And so we're always looking for those opportunities out there. And who knows, maybe there is going to be some options here for gold mining stocks and other gold-related ETFs and things like that moving forward. So we'll keep our eye on that. Oil was down today. And so it was down 2.25%, it looks like here. And you can see that oil has really been struggling here recently. In fact, you've basically had a red moving average since pretty much the end of June, right? And is it a coincidence that the stock market started recovering right around there? I don't think it's a coincidence, right? The oil, in a lot of ways, has dictated the fortunes of the market this year as well. And the reason I say that is naturally one of the big conversations we're having in 2022 is what's going on with inflation. And one of the most important elements of inflation in a lot of people's eyes is the price of gasoline, which of course is a derivative of what's happening with oil, all else being equal. And so when oil prices were going through the roof earlier this year, gasoline prices were following suit. When you're paying more money for gas, you're paying less money or you're spending less money on other things. And therefore, the rest of the economy suffers because more money is being funneled to the oil companies, less of that money that would have otherwise gone to a clothing retailer or something like that it goes up poof like smoke in the air, right? It's gone. It's in the gas tank now. And so, I think this has been another part of the story as to why the stock market has been able to gain its traction that it has here. You've actually seen some really serious bearish activity out of oil itself, and that has freed up some of that discretionary spending in other areas like Walmart or Home Depot or some of those retailers that we discussed earlier. So another tough day there for oil, down over 2%. It remains with a strongly bearish posture. In terms of what's been going on up here in the upper rung, you can see that we were down with foreign stocks here today, but not by much. Let's call it flat because EFA was down 0.03%, EEM was down 0.02%. So that is basically break even for all intents and purposes. But as we look at these three charts, what kind of catches my eye? So here's the S&P 500 representing U.S. large caps. Here's developed foreign stocks, EFA, and here's emerging foreign stocks, EEM. When I look at those three charts, to my eye, it does look like the U.S. is a lot stronger than the foreign areas of the world. The U.S., as I mentioned before, has the nice aspect of breaking out over that prior resistance area, whereas notice EFA is still tremendously down from where it was trading just at the beginning of June, and EEM is still tremendously down from where it was trading at the beginning of June, whereas the S&P 500 is at 3-month highs right now. So it does seem like the United States is once again in a leadership role. And remember, that has been the case more times than not in the last decade, which I've personally found a bit more peculiar. Remember, I see things through the lens of a U.S. citizen. I know many of you are listening to us from around the world, and we're happy to have you there, so you'll have to forgive us when we think in those terms, but we all have a little bit of a home country bias to a degree as investors. But it's always been surprising to me that the United States has been as resilient, and not just resilient and like retaining value, like actually leading the world from a stock market perspective in much of the last decade. In my head, I continue to think, well, the United States is one of the largest, most liquid, and most important economies on the planet. All of those things we do have going for us. But that doesn't always lead to better performance. A lot of times you kind of think in terms of law of large numbers or what have you. And if the United States has already done so well in past decades, how can it possibly continue to do well at an ever rapid pace in the future? And you kind of think of the scrappy, up and coming, emerging markets out there as maybe being able to take a leadership role because of their population growth and a much bigger opportunity to take folks from lower classes into the middle class, right? That sends a big message to profit-making enterprises. So, it's been a little bit surprising to me. Don't get me wrong. I'm not complaining about it. I'm very thankful for it as somebody who has benefited from that strength in U.S. stocks. But it is just surprising, and it makes me wonder, when will that end? Because you got to figure it will end at some point, or at least cycle out of that strength and give way to foreign strength out there. But we haven't really seen it, and maybe it'll require a major rollover in the U.S. dollar in order for that to eventually happen. And as I mentioned before, with the dollar up here, sitting closer to its highs of the 3-month period than the lows, we're just not quite to that point yet. So if that happens, and when it happens, we'll, of course, report upon it here in these videos. But right now, I would say that it is the U.S. stocks that continue to lead the way, all else being equal. Of course, there's always exceptions to the rule, but in general, broad strokes, the United States market does seem stronger than most other foreign markets that are available out there from a publicly traded perspective. Let's go ahead and take a look at our Sector 12 grid now. This is chart 5C for those of you that are premium members following along at home. And here we have a somewhat rare clean sweep. What I mean by that is all of these charts are dark green, telling us that we have strongly bullish postures on all of the sectors in the United States. That's really saying something considering the temperature check of a lot of market participants right now. A lot of people don't want to believe it. A lot of people are fighting this rally. A lot of people are saying it's all phooey. It doesn't deserve it. You name it. The excuses will come out. But the truth of the matter is, just look at the evidence in front of you. These are some pretty good-looking charts, all else being equal. We have a number of them hitting, multi-month highs here, including the S&P 500 itself, but you could throw financials into that category. Remember a couple weeks ago I was telling you about my, recognizing some of the financials really starting to perk up again. Well, they've had a heck of a rally in just a week. Who knows whether that continues, but we can see that today the financials have officially broken through to new 3-month highs. They did surpass their high on May 27th. They're not alone. Technology already surpassed its high several weeks ago, which is why technology has been number one on the sector selector as long as it has. But really, it surpassed its high back here on July 29th. We're already halfway through August, and we've been continually going even higher beyond those prior highs from a 3-month perspective. Again, we're not talking about 52-week highs, but from a 3-month perspective on these charts, technology is looking pretty strong. Same thing goes for discretionary. We hit a new 3-month high on discretionary today. Same thing on industrials, 3-month high on industrials. Same thing with utilities, 3-month high on utilities, and pretty much the same thing on real estate. It was down just a touch today. Technically, yesterday was a high, but you get the point. There's some pretty good looking charts here. You know, are they perfect? No. Do they look a heck of a lot better than they did just a month and a half ago? Of course they did. And at what point you got to ask yourself, will you change your mind? If you're somebody who continually thinks this market is bearish, at what point does that break? Because as I've mentioned before, markets have a tendency to go to all-time highs. And I'm not here saying that I believe they're going to go straight back to all-time highs right now, because I even have my own skepticism. But I'm just kind of, spitballing here for you to kind of get yourself to question, what will it take for you to admit that the markets are now bullish and not bearish, right? And that's a tough thing for all of us to come to terms with. And there is no perfect science around it. That's what makes things interesting. Markets are highly variable. But I think the truth of the matter is many of these charts are shaping up quite bullishly at this moment in time. Is it possible that the Fed indeed will have a soft landing? I know a lot of people thought that was impossible before, but the markets are maybe telling us a slightly different story right now. If that changes, of course, we'll keep on top of it. That's the whole point of doing the videos as regular as we do. But as of this moment in time, what this posture setting mechanism is telling us is that we do have strongly bullish postures on all of the sectors. It's not just some random ones here and there that are popping up. All of the sectors in the United States currently strongly bullish according to the market forecast technical indicator. Not only that, but you'll notice that on all 12 of these charts right here, they all have green 30-day moving averages as well, telling us that price is above a rising moving average on all of them. Remember, some of them are not at 3-month highs. Many of them are, but about half of them are at 3-month highs, half of them are not. But all of them are stable enough where they're trading above rising 30-day moving averages, which all else being equal is a quite bullish feature. So, are we due for some sort of a give back? Of course we are. We've gone pretty much straight up for a month and a half. The question now will be, what happens when that eventual sell-off takes place? And if you're somebody who stares at charts long enough, you probably come to the determination that if there is some sort of a sell-off and we're this far above the 30-day moving averages in almost all of these charts cases, that there's a better chance than not, at least on the initial sell-off, that we'll have stabilization and actually a support bounce before we start breaching those 30-day moving averages to the downside. So that's another thing that you're going to have to park in the back of your mind to start thinking about if you do start to see the market rolling over. Don't make the assumption immediately, here we go, now we're going to go back to those lows from earlier this year. Instead, you should be thinking, okay, when we get some sort of a sell-off, how do those candles look as it looks like that selling is exhausting itself? And is it happening above a rising moving average? And if it is, then that could very well be a time to reload the gun, so to speak, for bullish trades to the upside. So it's going to be fun to see how things play out here as we head towards the midterm elections in the United States, and of course head into a more bullish time period of the year from a seasonality perspective as we head towards year end here as well. So some good performance here on a lot of these charts today. The worst performer was actually real estate, but it wasn't a terrible performance, only down 0.39%. In terms of who the best performer was here today, looks like it was probably the consumer staples, up 1.13%, courtesy of Walmart. Remember, Walmart is a consumer staples company. And then consumer discretionary was right behind it with an increase of 1.1%. And that was courtesy of Home Depot, which happens to be a discretionary stock. So the consumer appears to be alive and well, at least here in the United States. All right, let's go ahead and get into our trade application example here today. Speaking of consumer staples, who led the way here today, our bullish trade idea will come from that particular sector. So let me go ahead and load up chart 3A, and let's take a look at Mondelez. This is the company that is behind the Oreo cookie, for those of you that are curious. They were spun off quite a long time ago from Kraft, which itself was spun off from, Philip Morris Altria, yada, yada, yada. This is part of that lineage that dates back many decades. But Mondelez is still one of those names that doesn't really roll off the tongue for a lot of people, so I like to remind them that they actually have some heft behind them. They're the company behind the Oreo cookie. They also have Toblerone chocolate and other snacks that many of you probably enjoy, and they're a large player in the business. It's not just some sort of an afterthought of a company here. But as you can see, Mondelez has had really nice back-to-back sessions here. Now, prior to the last 2 days, you can see that Mondelez was largely going sideways for about a week or so. So it was calling into question whether they had the strength to continue to rise. And sometimes that happens as well. Remember, when the rest of the stock market gets really bullish, it is possible for the consumer staples to either lag behind or perhaps even go lower in an absolute sense, because sometimes money rotates, right? Why would you want to stick around in the slow-moving staples if the more exciting tech stocks are taking off? So sometimes people will sell their staples and then push into the tech stocks. So, you always have to account for that possibility. But in this case, after watching Mondelez go sideways for a week, the last 2 days have been rather impressive. We closed near the highs of the session on both of the last 2 days. You can see that that was strong enough of a bounce there to actually change the background color from pink to blue, which on this chart 3A is referring to the blue line on the market forecast technical indicator, otherwise known as the near-term line. And so it's more of a chart that we will use for my swing trading classes, where we're looking for bounce setups, which this one kind of qualifies for here. And so from a near-term perspective, we are back to a bullish posture as of yesterday's close. Even beyond that, if you were looking at the green intermediate line, it also is considered strongly bullish at this moment in time because it's in the upper reversal zone above 86 and happens to be rising as well. And you can see here that we were able to burst through that resistance area that was set at the beginning of August after having a remarkable move higher here in the end of July while it reported its earnings. Look at all those positive days in a row, and then it just needed to catch its breath, right? Take a little bit of a break, go sideways. Well, now it looks like it's caught its breath, and it wants to make another push higher here. Now, you do have a little bit of overhead resistance, so like any trade, none of them are perfect. There's always going to be flies in the ointment that you have to think through. And this one does have a high about 3 months ago, around 66, that it's going to have to try to get up and through. Today, it couldn't quite do it. We got up as high as 66.31, but you can see back here, we were trading at least as high as 66.45, and that's 3 months ago exactly, so maybe the candles immediately before that were even higher. So the point is, you do still have some resistance over there that you've got to do some work with. This one also has underperformed the S&P 500 over the last 3 months, so some of you might not appreciate that, but I think a lot of the sentiment amongst people that I talk with are that they recognize the strength in the market, but they are a little bit hesitant in chasing stocks. And so in some ways, people are looking for stocks that kind of look like this, that admittedly have underperformed the market, but in their eyes, it's a good thing because they haven't gotten too stretched yet. And so maybe Mondelez is one of those companies that is starting to slowly make its way higher. Now, in terms of the trade application that I did today for the video, remember the trade was already done while the market was open. We do that so that way we can let you guys that are premium members of Market Scholars know what the trades are before everybody else that's watching the free video that night. And so make sure you're taking advantage of our Telegram app for that information. But the trade that I did was a long call vertical. Now, I will admit to you, I didn't actually want to do the long call vertical. My preference would have been to sell a put spread on it. That's what I was trying to get filled. But unfortunately, the market makers weren't working with me here today, and sometimes that will happen, right? We can wish and hope all we want to get filled at the prices we want, but sometimes it's just not in the cards. And so I was not able to get that done on the puts spread side of the equation here today. Remember, the difference between the two, for those of you that aren't as well versed in the options world, at least the way that we teach it here at Market Scholars, is selling a bull put spread is a higher probability trade because you're selling out of the money strikes. And so you get the benefit of having a stock go sideways and you can still make money off of it. When we do long call spreads, like I did in this particular case, it's a debit spread, not a credit spread. And it is more directional because, it's not an out of the money situation purely like when we're selling put spreads. And so we do need movement on the securities in question in order to benefit from those trades. Now, the flip side of that is you have the opportunity to make more money on the long call spreads traditionally than you have the ability to make money on the bull put spreads because, where you have higher odds of success with selling a put spread, you have lower reward possibilities. On the flip side, when you're looking at these long call verticals like this one as a debit spread, you have slightly worse odds of success, but you have greater reward possibilities to the upside. So I guess that's the good news if it works out. Now, if it doesn't work out, then obviously that will not be something I will be excited about. But just wanted to be upfront with you guys on that as well, because generally speaking, I would opt to go with the higher probability stuff if I can help it, unless I saw a very clean breakout or something along those lines. And in this case, as I mentioned before, we're still trading below some of those levels from 3 months ago, and so it wasn't as clean as I traditionally would want. So this one may not work out as well as I wanted to, but I thought it would at least be a good example to add a little bit more bullish delta into the portfolio on a stock that doesn't feel like it is outlandishly overbought yet. And as I look at a lot of other stocks out there, you kind of get that sense with many other companies up 30-40% in the last month. This one's only up 10% in the last month, so it's a little bit more digestible, I guess, from that perspective. Okay, so in terms of the strikes that I did the September contracts. I think I did the 62.50 on the long side, and then the 72.50. I'd have to double check that. I'm not sure right in front of me, but remember the strikes and the fill prices and all that are available on the Telegram app for those of you that are premium members. But the way that we usually do it is we buy one in the money and we sell one out of the money. So in this case, whatever the strike immediately below 65 was the one that I bought, and whatever the strike was immediately above 65 was the one that I sold. So it might have been like the 62.50 and 67.50 or something along those lines. But the point is, it's a long call spread. It is directional in nature. Some of you might choose to just buy the stock and hope that this little pattern of higher highs and higher lows continues. Right? We've really seen that pretty nicely since really bottoming out here. Since June 14th, we've got a low, we've got a higher low, we've got a higher low, we've got a high, we've got a higher high, we now have another higher high, and now your hope is to get through this other resistance area over there. So some of you might choose to play this as just a traditional bounce swing trade with the stock instead of dealing with the options market, because you will find that the liquidity from an options perspective was not perfect with this one. It's a little bit of a slower moving company, so it doesn't have quite as much volume and open interest as you might find with something like Apple or Microsoft. So in the end, it's just an idea, an example, and that's all we're hoping to do here is try to help you, educate you a little bit on these various techniques. So hope you enjoyed the presentation. If you did, do me one favor, take 5 seconds out of your day, click like for me there on Twitter. As long as we're up and over 100 likes, by the time I'm scheduled to do this video again on Thursday, I'll be happy to do another full-length video for you, including a trade application example. If you prefer the shorter videos, don't click like. And if we're under 100 likes, then I'll just do a 15-minute version of the index posture setting mechanism with no trade application example. So we'll let you guys decide collectively. As always, we really appreciate your support. I hope you all have a great evening. I've got my kid going back to school tomorrow. Where did the summer go? So some of you parents out there are probably feeling that as well. So fall is just around the corner. Fun time of year with football starting up here soon and everything as well. So anyway, a lot to entertain us out there in addition to the fun we're having in the stock market. So best of luck with your trades and your investments. Goodbye for now.